Marie was always careful with her finances, but as she got older, she began to realize that much of her money was tied up in her home. I overheard a friend talk about how happy she was getting approved for a reverse mortgage and was intrigued, Marie tells Money Talk News. I hadn't heard about reverse mortgages before, but my friend's situation was similar to mine. Widowed, with substantial home equity but limited cash flow. So Marie decided to look into a reverse mortgage for herself, and she spoke with her financial advisor who explained that the home equity conversion mortgage, or the HECM, the most common type of reverse mortgage, are federally insured loans which are designed, in fact, to help seniors to access a portion of the equity in their home without having to make payments. Now, the value that reverse mortgages are is that they intend to help the senior age in place, and that is reassuring to Marie. Now, her story gives us a real-world example of how a reverse mortgage can be a strategic financial tool for staying in a current home or transitioning to a new one. And here's how it worked out for Marie, who asked to use a pseudonym to help protect her privacy. She bought her Arizona home for $340,000 in 2004. When she began to consider a reverse mortgage in 2008, the home's value had risen to $400,000. Now, her loan terms allowed her to borrow at that time approximately $160,000, but she chose instead to receive $600 a month for the first 6 years and then later increased it to $800. In addition to those monthly draws, which Marie covers her daily expenses with, occasionally she took withdrawals from the line of credit to fund home improvements, and that helped increase the value, she said, including a new HVAC system. Now, the interest rate at the time when she got her loan was 2.04%. And it was added to the loan balance each month, and of course she didn't have monthly payments. But in 2022, at the peak of the post-pandemic housing boom, she sold her Arizona home for $749,000 and then used part of the proceeds to repay about $106,000 that had accrued on the reverse and the other closing costs for the transaction, walking away with about $400,000. Although her first reverse mortgage was approved for up to $160,000, she didn't use all of the money, and the home appreciation really helped to offset the loan's increasing balance. Now, she used that money to purchase a new condo in Washington State for $319,000, paying in cash. But a few years later, her situation had changed again. She was now semi-retired at 81 and earning less with her part-time work, so she took out a second reverse mortgage, a HECM, on that Washington condo to avoid withdrawing from her investments. And her new loan terms approved her up to $137,000, which she turned into a $1,200 monthly draw for her expected lifespan of 92 years, or a 10-year payment. Since its inception, the CFPB, or the Consumer Financial Protection Bureau, has had a target on its back when it was passed as part of the Dodd-Frank Act in the wake of the housing crisis. But now a more wizened and experienced Donald Trump and his second administration is making moves to effectively neuter the agency. As reported earlier, staff and contractors at the Consumer Financial Protection Bureau were told last week or 2 weeks ago not to perform any work tasks, a strange request, that according to an internal email which was obtained by National Public Radio. Now, the latest development came last Monday, February 10th, and that's when the Bureau's acting director, Russell Voigt, closed the agency's Washington, D.C. headquarters for 1 week, so it was closed from February 10th, telling staff to work remotely. NPR reports no reason was given for the unexpected closure, but there may be a reason for the closure. Reports say that members of Elon Musk's Department of Government Efficiency, or DOGE, were actually seen at the CFPB Bureau's headquarters in D.C. on Friday, February 7th, just prior to the closure. But there may be an explanation for the closure. Reports say that members of Elon Musk's Department of Government Efficiency, or DOGE, were seen at the CFPB headquarters on Friday, February 7th, just before the closure. Employees should not come into the office. Please do not perform any work tasks, said Vogt in an email to CFPB staff last Monday. In essence, Vogt has just given these employees a paid 1-week vacation. However, these employees are rightfully concerned about their long-term prospects of employment. CFPB RIP, Musk posted to X, and Vogt posted on his own X account saying, "Pursuant to the Consumer Financial Protection Act, I have notified the Federal Reserve that the CFPB will not be taking its next draw of unappropriated funding because it's not reasonably necessary to carry out its duties." adding the Bureau's current balance of $711 million is in fact excessive in the current fiscal environment. This spigot, long contributing to the CFPB's unaccountability, is now being turned off, said Vogt. So now we have a closure, an examination by DOGE, and frozen funding, which may signal the end of an agency that has drawn both praise from Democrats and criticism from Republicans over years. NPR reports that the budget that was slated for the CFPB in fiscal year 2025 was $823 million. Since its creation in 2011, the CFPB has handled millions of consumer complaints, and during that time has returned $20.7 billion back to consumers. Wendell Primus is a name that few are likely familiar with, yet his reach is considerable amongst our nation's policymakers and members of Congress. Primus was the senior policy advisor on health and budget issues for Speaker Nancy Pelosi for 18 years. In that capacity, he was the lead House staffer in developing the Affordable Care Act, or Obamacare. Now, Primus is currently a visiting fellow for the Brookings Institution and has his own plan to fix Social Security. In a column posted late last month, the Center for Retirement Research's Alicia Minnell outlines Primus's 17-point plan to bolster the program's solvency and ensure payments for future retirees. And here are just a few of the proposed fixes that balance what he calls tolerable benefit cuts and realistic revenue increases. First is to gradually increase the taxable wage cap to $300,000. Presently, that cap, which is adjusted for inflation, stands at $176,000. The proposal would make the first $300,000 of earnings subject to the Social Security tax. Primus estimates that would eliminate 34% of the 75-year deficit. Next, Primus proposes to increase the payroll tax from a rate of 12.4 to 12.6%. That's modest. Another is to tax 100% of Social Security benefits. Yes, double taxation for individuals that make an annual income of $100,000 or more. More controversial proposals, including reducing the dependent spouse benefit by 5% each year until it's eliminated by 2036, increasing Social Security normal retirement ages, and placing all proceeds from taxation of Social Security benefits, including retrospective benefits, into the OASI and DI trust funds beginning in January 2027. As it stands today, mathematically and demographically, the Social Security program's solvency and ability to meet its obligations is in peril. Minnell writes in her conclusion, "Let's just enact this balanced, thoughtful, workable proposal. It would restore confidence in the system both for the young, many whom believe that they will never receive benefits, and for older workers and retirees who fear that their benefits will be cut. It would eliminate fear-mongering and misinformation. It would make Americans happier."